In 2019, this was the gold rush of the century. A plant that had been illegal for 100 years was suddenly legal, state by state, and Wall Street lost its mind. Analysts called it the next alcohol, the next tobacco. $100 billion industry appearing out of thin air. One company branded itself the Apple Store of weed and hit a $3 billion valuation before it turned a single dollar of profit. A beer giant bet $4 billion on it. 6 years later, that Apple Store of weed filed for bankruptcy. The beer giant wrote off over $1 billion. And across America, thousands of legal, licensed, tax-paying marijuana businesses quietly went dark. So how does a brand new legal industry, one everybody wanted, one printing real revenue, collapse while demand keeps going up? Here's the truth. Legal weed was never a gold rush. It was a trap. A business you could run perfectly, great product, packed stores, lines out the door, and still be legally required to lose money because the rules weren't written to let it succeed. They were written decades earlier to make sure it couldn't. This is the autopsy of the legal marijuana industry and the invisible machine built to bankrupt everyone who played by the rules. Chapter 1, The Green Rush. To understand the crash, you have to feel the boom. And the boom was intoxicating. Starting around 2014, state after state legalized cannabis. First medical, then recreational. Colorado, Washington, California. And to investors, the math looked unstoppable. Millions of people already smoked weed. They were already spending billions on it. All legalization had to do was move that spending from a guy in a parking lot to a store with a cash register and a tax ID. Take an existing multi-billion-dollar market and simply make it legal. How could you possibly lose? Money poured in. And the poster child for the whole era was a company called MedMen. MedMen didn't want to sell you weed. It wanted to sell you a lifestyle. Its stores looked like Apple stores. White walls, wooden tables, tablets, beautiful staff, and branded shirts. Its founders talked about becoming the first great cannabis brand, the Starbucks of pot, a chain on every corner in America. They threw parties. They ran a full-page ad in the New York Times, and investors handed them a valuation that peaked around $2 to $3 billion. Think about that. A company losing money on every store, in an industry barely a few years old, worth more than plenty of established, profitable businesses. Because nobody was buying the profits. They were buying the story, the land grab, the belief that whoever planted the most flags fastest would own the future. And the money would sort itself out later. It was the exact logic of a gold rush. Grab territory now. Worry about whether the mine actually produces gold? Never. And the giants believed it too. In 2018, Constellation Brands, the beer company behind Corona, bet $4 billion on a Canadian grower called Canopy Growth, eventually taking a nearly 40% stake. $4 billion on the theory that one day soon, you'd crack open a cannabis-infused drink the way you crack open a beer. Everyone was so busy staking claims, nobody stopped to ask the boring question. The one question that kills more businesses than any competitor ever will. Does this thing actually make money once the excitement wears off? It did not. And the reason why was hiding in a tax rule written in 1982, before most of these founders were even born. In 1981, a convicted drug dealer did something almost funny. He'd been busted moving amphetamines, cocaine, and marijuana, and when the IRS came for taxes on his profits, he fought back in tax court. He argued that if the government was going to tax his drug income, it also had to let him deduct his business expenses. The scale, the packaging, the phone, the miles he drove, like any other businessman. And here's the punchline. He won. The court agreed. Income is income. Expenses are expenses, even for a criminal. Congress was so furious that a drug dealer had just won a tax deduction that the very next year, they wrote a rule to kill it forever. Section 280E. One sentence in effect. If your business traffics in a controlled substance, you may not deduct your normal business expenses. None of them. It was written to punish cartels. But here's the catastrophe nobody saw coming. Marijuana is still, to this day, illegal at the federal level. A Schedule I controlled substance. sitting in the same legal box as heroin. So the moment a state made weed legal and an entrepreneur opened a spotless, licensed, tax-paying dispensary, the federal government looked at that business and saw, in the eyes of the law, a drug trafficker, and aimed a rule built for kingpins directly at a shop with a loyalty program. Now let me show you exactly what that rule does, because this is the whole crime. And the numbers are so absurd you'll want to check my math. Please do. Start with a normal store. Any store. It brings in $1 million in a year. It spent $600,000 buying the products on its shelves. That's its cost of goods. And it spent another $300,000 keeping the lights on. Rent, staff, marketing, insurance. Add it up, $1 million in, $900,000 out. Its real, actual profit is $100,000. The taxman takes a standard 21% of that 100 grand, about $21,000. And the owner keeps $79,000. A normal year for a normal business. Now the exact same store, down to the penny. Same million in sales, same $600,000 in product, same $300,000 in rent and payroll, same real profit of $100,000. The only difference is what's on the shelf. This one sells cannabis. Here's what 280E does to it. The one expense you're still allowed to subtract is the cost of the product itself, the $600,000. Everything else, the rent, the payroll, the marketing, the insurance, the IRS pretends it doesn't exist. It's not deductible. It's invisible. So the government doesn't tax your real profit of $100,000. It taxes you on $400,000. Your sales minus the product and nothing more. 21% of $400,000 is $84,000. Look at those two stores side by side. Identical sales, identical costs, identical real profit of 100 grand. The normal store pays $21,000 in federal tax. The cannabis store pays $84,000. 4 times as much on a business that made exactly the same money. Its effective federal tax rate isn't 21%, it's 84%. And that's before its state takes a cut, because it gets worse. Plenty of states with their own income tax simply copy the federal rulebook, which means they tax that same phantom $400,000 too. Layer even a modest state income tax on top, and the total tax bill on our little store sails past $100,000. Sit with that. The business earned $100,000 in real profit and owed more than $100,000 in taxes. It didn't just lose its profit, it finished the year in the red. The owner paid out of pocket for the privilege of running a successful store. And I've been describing a good year. Watch what 280E does in a bad one. Say sales slip to $800,000. Product still costs $600,000. Rent and payroll still $250,000. Do the honest math, 800 minus 600 minus 250. The store lost $50,000 this year. It's bleeding. In any normal business, a loss means you owe zero tax. You lost money, there's nothing to tax. But 280E doesn't care that you lost money. It still only lets you subtract the product. 800,000 minus 600,000 is 200,000 of income in the government's eyes. And 21% of that is a $42,000 tax bill. So you lost $50,000 running your store, and the IRS handed you a bill for $42,000 more. You are $92,000 down. In a year you were already drowning, taxed on profit that does not exist. And that's the machine. And notice who it hurts most. A grower can bury some of its cost inside the cost of the product and shield them. But a dispensary, the store, the part of the chain closest to you, the customer, mostly paying rent on an expensive corner and wages to a smiling staff, has almost nothing it's allowed to deduct, which is why, again and again, it was the retail stores, the busiest and most visible face of legal weed, that died first and died hardest. This is why you'd see it again and again. A dispensary with lines out the door, shelves flying empty, more customers than it could handle, quietly going bankrupt. The store wasn't failing, the store was winning. The tax code was simply designed to take the winnings. And here's the lesson worth stealing from this whole graveyard. Lesson 1. Revenue is not a business. A line out the door means nothing if the rules let someone reach into the register before you do. Before you fall in love with a market, find out who else is legally entitled to your money. But the tax was only the first trap, because even the money these businesses did keep, they had nowhere to put it. Picture running a business that does millions of dollars a year and no bank will touch you. That was cannabis. Because banks are federally regulated and marijuana is federally illegal, most banks, the ones with FDIC insurance, which is almost all of them, simply refuse to open accounts for cannabis companies. Taking that money could be called money laundering. So they said no, which meant these businesses became islands of cash in a modern economy. Customers paid cash. The store paid its staff in cash. It paid its suppliers in cash. And when the enormous tax bill came due, the one we just walked through, it often paid the IRS in physical cash. Employees hauling literal bags of money to a government office. Stop and picture the danger. A retail store, everyone in the neighborhood knows it's cash only, with tens or hundreds of thousands of dollars on site because it can't be deposited anywhere. It's not a dispensary, it's a target with a logo. Robberies became a grim routine of the industry. Some operators were hit again and again because everyone knew the money had nowhere to hide, and the absurdity peaked at tax time. Remember that crushing 280E bill from the last chapter? A business with no bank account had to pay it somehow. So there were cannabis operators literally counting out hundreds of thousands of dollars by hand, loading it into bags and boxes, and driving it to a government tax office to pay the very tax that was strangling them. In cash, because the same government that demanded the money wouldn't let them hold it in a bank. A perfect little snapshot of the whole industry. Legal enough to be taxed to death, illegal enough to be locked out of the banking system, all at once. And it went deeper than safety. No bank account means no normal loans, no lines of credit, no boring financial tools every other business uses to survive a rough quarter. When times got hard, and they were about to get very hard, a normal company calls its bank. A cannabis company had no bank to call. It had a safe full of cash that was somehow never enough. Congress kept promising to fix this. A banking bill came up year after year with a friendly name and bipartisan support, and year after year it died. The businesses kept operating in a financial cage the government built and then refused to unlock, which is lesson 2. In a real business, the unsexy infrastructure, banking, payments, credit, isn't a detail. It's the plumbing. And a beautiful house with no plumbing is not a house. It's a very expensive tent. So now our legal weed business is taxed like a cartel and banked like a criminal. And it still hasn't met its most dangerous problem, the one hiding inside the word legal itself. Here is the strangest part of the whole story. Marijuana is legal in many states and illegal federally at the same time. And that contradiction quietly destroyed the economics of the entire industry. Because federal law controls the borders between states, and federal law says cannabis is illegal, so it is a crime to move legal marijuana across a state line. A grower in Oregon cannot legally sell to a shop in Nevada. A California farm cannot ship to New York. Every single state is sealed off. Its own tiny walled-off market that has to grow, process, and sell every gram entirely inside its own borders. Now watch what that does. In a normal industry, if one region grows too much of something, it ships the surplus to a region that has too little. Prices stay balanced. That's just trade. It's how economies breathe. Cannabis couldn't breathe. When a state like Oregon or California licensed a flood of growers, and those growers did what growers do, grew a lot, the state drowned in weed. In one mature market, licensed production roughly tripled in a few years, while actual sales only doubled. So every harvest, the mountain of unsold, legal cannabis got taller. And because that surplus was legally trapped inside the state, forbidden from escaping to anywhere that needed it, there was only one thing it could do: collapse in price. Wholesale cannabis that sold for over $500 a pound fell toward $100, in some places even less. Farmers watched the value of their entire harvest fall by 70, 80, 90%, with no way to sell it somewhere else because somewhere else was a federal crime. So picture the full squeeze now on one grower. The price of your product just cratered because your state made too much and you're forbidden from selling it anywhere else. Meanwhile, the taxman is treating your shrinking income like an 80% event, and your money's in a safe because no bank will hold it. Every direction you turn, a wall. That's lesson 3, and it's the deepest one. Understand the whole board before you make your move. These founders analyzed the demand for weed, which was massive and real, and never mapped the rules around it. They bet on the plant. They lost on the plumbing, the tax code, and the borders. The product was never the problem. The system it had to live inside was rigged from the first day. And even after all of that, there was still one more competitor waiting. One that paid no tax, needed no bank, and had a 30-year head start. Here's the fantasy that sold legalization to investors. Make weed legal, and the illegal market simply disappears. Everyone happily switches to clean, taxed, regulated stores. The dealer goes extinct. It did not happen. And the reason is a number. When a state legalizes cannabis, it also taxes it heavily. Cultivation taxes, excise taxes, state sales tax, local city taxes, all stacked on top of each other. Here's a comparison that says everything. In California, the excise tax on a bottle of wine is about 4 cents. The excise tax on a small 1/8 ounce of cannabis? Nearly $5. That's over 100 times more tax on the plant the government just made legal than on the alcohol it's sold for a century. Add every layer together and the tax baked into legal weed can push toward 40% or more of the price on the shelf. So a customer walks in, on the legal shelf, a product that's been tested, tracked, and taxed into the stratosphere, and still available on the same street from the same guy as always. The illegal version. No tax, no testing. 40–50% cheaper. Cash, easy, done. Which one wins? For millions of people, the cheap one. Years into legalization, in the biggest market in the country, studies found that roughly 2 out of every 3 cannabis purchases were still happening in the illegal market. The majority of weed consumed came from unlicensed sellers, and the scale of it is almost comic. In California, by recent estimates, illegal growers produce something like 8 times more cannabis than the entire legal licensed industry. 8 times. The legal market, the one with the stores and the taxes and the testing labs, was the small one. The illegal market didn't shrink after legalization. It stayed the giant, now competing against a legal rival the government had deliberately handicapped with taxes. So the legal operator faced the final insult. It followed every rule, paid the crushing tax, absorbed the banking nightmare, ate the price collapse, and then had to compete on price against an enemy who followed no rules at all and had none of those costs. It's like being forced to run a race in ankle weights against someone who gets to ride a motorcycle, and then being blamed for losing. Lesson 4. Regulation is not the same as a market. A government can make something legal without making it survivable. If the legal version of a thing costs far more than the illegal version, people were already happily buying. Legal is not an advantage. It's a price disadvantage with paperwork. By 2022, all 4 traps had sprung at once, and the giants of the industry started to fall. Let's count the bodies. Remember Constellation Brands, the beer company that bet $4 billion on canopy growth? By late 2022, it wrote down that investment by over $1 billion in a single stroke. Canopy itself posted losses in the billions. 1 year alone, a net loss north of $2 billion, and watched its stock lose the overwhelming majority of its value. The cannabis beer future never arrived because the federal government never let it. $4 billion, chasing a market that was legally forbidden from ever fully forming, and Canopy had company at the top of the graveyard. Its great Canadian rival, Aurora Cannabis, had also raised and spent staggering sums, built greenhouses the size of small towns, promised the world, and then wrote off billions in value as the same walls closed in. 2 of the largest cannabis companies on earth, both essentially monuments to the same miscalculation, that the demand for the plant would be enough, and the rules would sort themselves out. The demand was there. The rules never moved. And MedMen, the Apple Store of weed, the $3 billion darling, its story reads like a warning label for the entire era. The founder was pushed out in 2020 amid lawsuits accusing leadership of pumping the stock and burning company money on a lavish lifestyle. Private security, customized Escalades. While the business bled. By the end of 2022, MedMen reported a working capital hole of over $130 million and barely $15 million in cash. It had once run 25 stores with dreams of going global. On April 24, 2024, MedMen filed for bankruptcy. Over $400 million in liabilities. Nearly every store dark. And it wasn't just the famous names. Across mature markets, hundreds of licensed dispensaries closed. In just one California county, the number of legal retailers fell by a third in 2 years. An entire generation of entrepreneurs who did everything right, got licensed, paid their taxes, followed every rule, wiped out. Not by failure, by design. So here's the Autopsy report on the legal marijuana industry and the final lesson, the one that ties the whole graveyard together. Every business lives inside a system of rules, and most of the time you never notice them. They're just the air. But cannabis is what happens when the rules are quietly turned against you, taxed like a cartel, banked like a criminal, walled inside your own state, and undercut by an untaxed ghost. Any one of those could sink a company. Legal weed had to fight all four at once from day one, while being told it was a gold rush. The founders thought they were in the marijuana business. They weren't. They were in the surviving the rules business, and almost nobody read the rules before they bet their life on them. Out of business, MedMen, April 24, 2024. Cause of death, a business the rules were written to kill. The plant grew just fine. It was the system around it that was engineered to fail, which leaves one uncomfortable question. When an industry collapses, even though customers never stop buying, was it ever really a free market? Or just a slower way of saying no? Some companies get killed by their own greed. Others get killed by rules written decades before they were born. WorldCom faked $11 billion in profits that never existed and got caught by 3 auditors working past midnight. That story is on this channel, WorldCom Scandal, America's biggest accounting fraud. Watch it next.